If you already invest, then you all know what to do to get your money into an investing ISA before the end of the tax year. But what if you are new to the game? Firstly, before you look at the how and the what, you need to consider the why when it comes to investing. It shouldn't be done with your rainy day fund, nor money you will need in the short term, but if you have long-term savings over and above that, then investing makes sense. The past 18 years have seen 2 major stock market crashes and the financial crisis. Yet the average cash ISA has returned 0.89% a year above inflation, while the total return from the UK stock market was 3.66% a year above inflation. According to figures from Schroders, over the long term, not investing in shares means you are passing up the best chance of inflation-beating returns. Investing makes your money work harder, and the longer you do it for, the less likely you are to lose out. You can also start with a relatively small sum of money, as little as a few £100 as a lump sum, or £50 per month with some services. When it comes to how to invest, for most people the cost of a financial advisor or wealth manager will feel prohibitive for their simple investing needs. That leaves 2 main options: get someone to do it for you or do it yourself. The former has become easier and cheaper in recent years with the advent of online wealth managers, or robo-advisors as they are often called. These offer tools to help you establish your goals and risk levels and build a portfolio that they will manage for you. You pay a bit for this, but what you get in return is easy investing. If you like the idea of this, then read our robo-advisor roundup and visit a few to try out their websites and get a feel for them. Most allow you to use their tools with a no-obligation email sign-up. If you want to pick investments yourself, then it is best to sign up to a DIA investing platform. These let you buy and hold shares, funds or investment trusts, and you can use our DIA investing platform roundup and comparison tool to help choose the best for you. The final step is what investments to choose, and this is where most people fall down. Even if you forego picking shares yourself, something only really suited to the most committed investors, and go for funds or investment trusts that pool investors' money to invest in a range of companies, there is a baffling array to choose from. Most people are not concerned with finding the absolute best investment, but are worried about picking a bad one. Don't stop here though, it doesn't have to be difficult. The key is to think as broad and simple as possible and to understand a bit about asset allocation. This sounds complicated, but is simply about not putting all your eggs in one basket and how you can take more or less risk with your investments. At the simplest level, there are 2 main investing elements: shares and bonds, both of which can be bought through funds and trusts, which will spread your money about for you. Shares are judged to be riskier but offer greater rewards, while bonds are believed to be safer but offer less opportunity for gains. Shares involve buying a stake in a company, while bonds involve lending a government or company money for an interest rate return. The safest bonds are considered to be top-grade government bonds in your home currency, and fortunately for British investors, the UK's government bonds, known as gilts, make the cut here. The traditional way of taking less risk with your investment portfolio was to hold more bonds. So a very adventurous portfolio might be 100% shares, while a middle-of-the-road one would be 60% shares and 40% bonds, and a low-risk one 20% shares and 80% bonds. The problem for investors at the moment is that bonds pay very little interest and are historically expensive to buy, due to the super low interest rate world and quantitative easing that followed the financial crisis. If you want to keep things really simple, it is possible to replace bonds with cash in a good interest-paying savings account. Keep this separate to other savings pots and think of it as a whole alongside your funds invested in shares, with a greater or lesser proportion of cash based on how much risk you want to take. When it comes to choosing which funds or investment trusts to use, take advantage of best funds lists produced by DIA investing platforms, which should weed out the bad options. This is Money also has its own 50 best funds list. There is a choice to make over active funds, where a manager tries to cherry-pick the best investments, or cheaper passive funds that just follow a stock market index. If you want to go active, then choose a fund or investment trust that is not too expensive and has a manager who you think will add value but not too much risk. If you choose a passive tracker fund, then aim to keep costs low. Whichever route you take, a global fund or trust can form the core of your portfolio. which you can then invest more into on a monthly basis, and as you gain confidence you could then start adding smaller satellite investments in other areas if you wish. That's the Whistler Stop Tour. For a more in-depth look and some ideas to get started, read our How to Invest in an ISA guide here. If you decide to invest, then do your research carefully. How to be a successful investor is This is Money's easy to understand and jargon-free guide to the world of investing. Our guide is designed to help both those new to investing and those who already invest, with tips to help them along the way. The guide is written by This is Money editor Simon Lambert, who writes a regular Minor Investor column and presents the Investing Show. The 40-page PDF guide is short enough to be read in one sitting, but you can also keep it for reference when investing. You can download it here or by clicking on the button above.
Where the freaks at?